While most people are distracted by holiday shopping and year-end festivities, a $52 billion dynamic is quietly building inside the commodity markets. By the time the wider public notices, the chance to understand it or get ready for it will likely be gone. What I'm about to lay out combines math, market mechanics, and a calendar-based event that shows up once a year. This time, though, the setup looks nothing like what we've seen for more than a decade. Tomorrow begins what traders often refer to as Ghost Week. It's a 10-day stretch when markets are technically open, but the participants who keep them running largely vanish. Bank trading desks shut down, hedge fund managers head out on vacation, market makers, who normally keep liquidity flowing, step away from their screens. In periods like this, trading activity can fall by 70% or even more. Here's the key difference this year. Silver just finished at $80.14 an ounce on Christmas Day. At the moment, roughly 1,45000 futures contracts are concentrated in the March 2026 delivery window. Each contract represents 5,000 ounces of silver. Multiply that out, and you're looking at 725 million ounces of exposure, about $52 billion, essentially locked in place as the market moves into a liquidity blackout. To see why that matters, picture a real-world case, running a solar panel manufacturing plant. Your production line needs 50 kilograms of silver every single day. In solar panels, silver isn't a nice-to-have. Its electrical conductivity makes it extremely difficult to replace in converting sunlight into power. Normally, your procurement team buys futures months ahead to secure pricing and reduce volatility. That's standard risk management. But what happens when the usual sellers aren't available? When market makers are away, institutional desks are closed, and liquidity providers have stepped back for the holidays? You're still responsible for delivering finished products, but the market you rely on to secure raw materials is no longer stable. Now scale that situation across hundreds of industrial users at the same time, solar manufacturers in China, India, and the US. Automakers building EVs with silver-heavy electrical systems, electronics, producers making everything from phones to medical equipment. They all need silver, and they all run into the same liquidity drought starting tomorrow. CME Group data shows silver futures open interest has been rising consistently since September 2025. That isn't random noise. It reflects real positioning by real participants with real manufacturing and hedging needs that start coming due in February and March. Once the 22nd of November 2025 arrived, the March 2026 contract became the main trading hub. New hedges, industrial buying, and speculative flows increasingly piled into that single contract window. And that window now lines up perfectly with the thinnest liquidity conditions on the entire calendar. If this kind of market breakdown is useful to you, consider following along for more analysis like this. Supporting the channel really helps keep this kind of content coming. This is for educational purposes only and should not be treated as financial advice. Always speak with a qualified financial professional before making any investment decisions. Now we need to walk through the timeline-driven chain reaction that's about to play out. Markets were closed yesterday for Christmas. Today is December 26th, Boxing Day, which means London, Hong Kong, and Singapore are closed as well. Then the weekend arrives. On December 30th and 31st, we'll be looking at skeleton staffing at best, with New Year's Eve celebrations shutting down whatever limited activity is still left. On January 1st, 2026, global markets close again for New Year's Day. We won't see anything close to normal liquidity until January 2nd at the earliest, and possibly not until January 5th. Realistically, that's 10 full days of effectively stalled markets, while industrial demand continues without pause. Before we go any further, I want to be crystal clear about something. This analysis is strictly educational. I'm not a financial advisor, and nothing in this video should be taken as financial advice. You should always do your own research and consult qualified professionals before making any investment or business decisions. Markets involve substantial risk, and you can lose money. This disclaimer applies to everything discussed here. Now, let's look at why those 145000 contracts are not just numbers on a screen. They represent real metal that real companies urgently need for manufacturing that cannot simply stop. Industrial silver demand reached a record 680.5 million ounces in 2024. That's not a small uptick, it's a historic high. According to the Silver Institute's World Silver Survey, it's the highest level of industrial consumption ever recorded. Put that beside supply. Total global silver mine production across all countries was only 813 million ounces in 2024. Do the subtraction. We mined 813 million ounces. Industry used 680.5 million ounces. That leaves just 132.5 million ounces for everything else. Jewelry, investment demand, coins, medical uses, and the strategic reserves that governments have been building since silver became a United States critical mineral. But here's where the math starts to look genuinely alarming. Industrial demand isn't a steady baseline anymore, it's speeding up, driven by a technology shift that's consuming silver at levels very few people anticipated even 5 years ago. Solar photovoltaic manufacturing alone used more than 200 million ounces of silver in 2024. That's over 30% of total industrial demand concentrated in a single application. And projections suggest that share is set to rise further. The solar industry has moved towards something called TOPCon technology, tunnel oxide passivated contact cells, if you want the technical term. What matters for our silver discussion is this. TOPCon panels require 50% more silver than the previous generation of PERC technology. Not 5%, not 10%, 50% more silver per panel. Based on projections from the International Energy Agency and a range of solar industry analysts, the global solar sector is expected to require between 1,000 and 1,4000 tons of silver each year by 2030. Let's translate that into the same units we've been using. 1,4000 tons is roughly 450 million ounces coming from one industry alone. Keep the global supply figure in mind, about 813 million ounces from total mining worldwide. If solar demand reaches the upper end estimate of 450 million ounces, and other industrial uses stay near current levels, total industrial consumption would push beyond 900 million ounces. That's more than 100% of global mine output before a single ounce is even allocated to jewelry, coins, or investment demand. Here's what makes the supply picture even tighter. Most silver isn't produced from pure silver mines. Around 70% of silver output comes as a byproduct of copper, lead, and zinc mining. When copper miners run their operations, silver shows up as part of the process. But copper producers aren't going to ramp output just because silver prices are high. They make decisions based on copper economics. Silver is essentially a secondary revenue stream. Silver Institute data reinforces this point. Global silver mine production growth has averaged under 1% per year over the past decade. Over that same period, industrial demand has climbed by about 15%, with further acceleration expected through 2030. Supply rising at 1% annually, demand rising at 15%. You don't need an economics degree to see where that gap leads. And that brings us to what may be the most important point of all. The silver market has run deficits for 7 straight years, not surpluses, not balanced deficits. 7 consecutive years in which the world used more silver than it produced. The 2024 deficit alone reached 148.9 million ounces, according to compiled industry data. That's nearly 20% of annual mine production, effectively vanishing from available supply. Add up the deficits from 2021 through 2024, and you get roughly 678 million ounces, about 10 months of global mine output. Nearly a full year's worth of production that has been pulled from inventories, ETF holdings, government stockpiles, and recycling flows just to cover the gap between what gets mined and what gets consumed. So, here's the question mainstream financial media rarely seems to ask. Where is that 678 million ounces coming from? When demand exceeds supply for 7 consecutive years, you're drawing down stored inventory. But inventory isn't infinite. Eventually, you reach the point where there's nothing left to draw down. According to the CPM Group and the Silver Institute, identifiable above-ground silver inventories have been declining. Silver-backed exchange-traded products absorbed 95 million ounces in just the first half of 2025 alone. That's investment demand competing directly with industrial users for the same finite supply. Think about the mechanics of what's happening. A solar panel manufacturer in California needs silver to make panels. An investor in New York wants silver as an inflation hedge. An automotive company in Michigan needs silver for electrical systems and new vehicles. They're all competing for ounces from the same 813 million ounce annual supply. And that supply hasn't grown in 8 years, while demand has surged by double digits. Economic theory tells us what happens in this scenario. Price rises until demand is destroyed or new supply is created. But we've already established that new supply can't materialize quickly because of the byproduct nature of silver mining. So the entire burden of rebalancing this market falls on demand destruction through higher prices. How high do prices need to rise to destroy industrial demand for silver? That's the critical question. Can a solar manufacturer simply decide not to use silver and substitute cheaper materials? The technical answer is not easily and not without completely redesigning panel architecture, which takes years and billions in research and development investment. Can automotive companies eliminate silver from electrical systems? Not when silver is the most electrically conductive metal available at commercial scale, and modern vehicles require increasingly complex electrical architectures for safety systems, battery management, and autonomous driving features. Can medical device manufacturers stop using silver in antimicrobial applications? Not when silver's unique properties make it irreplaceable for certain critical health applications. The brutal reality is that industrial silver demand is remarkably inelastic. That means it doesn't decrease much even when prices rise substantially. If you're still with me, hit that like button. It tells YouTube to show this analysis to more people who might benefit from understanding these market dynamics. A solar company might grumble about paying higher prices instead of lower ones. But if they need the metal to fulfill panel orders worth millions of dollars, they pay the price. The silver cost, even at elevated levels, is still a small fraction of the total panel manufacturing cost. This inelasticity is precisely what creates the conditions for price explosions during liquidity crunches. When buyers can't delay purchases because manufacturing schedules are locked in, and when sellers vanish because liquidity has evaporated, the market has no mechanism for orderly price discovery. It doesn't move smoothly anymore, it gaps violently, suddenly, and once it happens, you can't take it back. We saw early signs of this in the late December price action. UBS strategists didn't describe the market as unhinged for no reason. They were reacting to price behavior that had started to separate from normal supply and demand fundamentals, driven instead by positioning and tight liquidity. The mechanism is straightforward. When global markets are closed and real volume disappears, even modest buying pressure can produce outsized moves. Now scale that into the first week of January, when weeks of delayed purchasing collides with the reopening of futures markets, and the math starts pointing toward a potentially significant price swing. Here's the institutional positioning paradox that makes this even riskier. In normal conditions with healthy liquidity, large institutions can manage exposure in a controlled way. They can add here, trim there, roll positions forward, or reduce risk gradually. They have flexibility, they have time, and they have counterparties ready to take the other side. But during Ghost Week, those normal tools stop working. If you're short March 2026 silver futures and you want to close to limit risk, who's taking your buy order when market makers are away? If you're a commercial hedger who needs to roll exposure from March into May, where's the liquidity to execute that roll without getting crushed by slippage? The answer is simple. It isn't there. During this 10-day window, the liquidity just doesn't exist. So institutions are left with two basic choices. Either they get positioned before Ghost Week begins and accept that they're locked in, or they wait and then pay whatever price is required to adjust once markets reopen. With record open interest heading into this holiday period, it looks like many players picked the first option. Lock the position and hope conditions don't turn against them. That's 145000 contracts, billions in notional exposure effectively frozen while the market slips into suspended animation. Now picture this through the eyes of someone running a corporate hedging program. You're the procurement director at a major electronics manufacturer. Your company uses 500,000 ounces of silver every month in production. Back in November, you hedged your February and March needs by buying futures at a price level that seemed reasonable at the time. That's textbook risk management. But now it's December 26th, and you're watching the market enter a liquidity blackout. Your hedges exist, but you can't actively manage them. You can't take profits if prices move in your favor. You can't quickly add protection if prices move against you. The market structure won't allow it. You're simply stuck until normal trading resumes. Multiply that situation across dozens of industrial buyers, hundreds of desks, and thousands of individual futures positions, and you start to see why the March 2026 contract has turned into a pressure cooker. Everyone is locked in, nobody can adjust, and the only real pressure release valve market liquidity doesn't return until January 2nd at the earliest. The 7-year deficit story we covered earlier isn't old news. It's the base layer underneath today's price action. Every ounce of that roughly 678 million ounce cumulative deficit had to come from somewhere. It came from inventory drawdowns in ETF holdings, the melting of old jewelry and coins, releases from government stockpiles, and the draining of commercial inventories. And according to the World Silver Survey, identifiable inventories across exchanges, ETFs, and depositories have been sliding lower even as prices have moved higher. That is the exact opposite of what standard economic theory would suggest. Normally, rising prices pull more metal into the market. Higher prices encourage more production, more recycling, and more selling. But we're not seeing that response because, in the short term, the supply simply isn't there to be brought to market at any meaningful scale no matter the price. Once inventory drawdowns can't keep covering the gap between what's produced and what's consumed, the only remaining balancing mechanism is price. Not slow, orderly increases that give demand time to adapt, but abrupt price discovery that forces immediate market clearing. We're about to learn whether current price levels are high enough to materially reduce industrial demand and bring this market back into balance. My read of the data suggests we're not even close. Solar installations aren't easing off, they're expanding worldwide, supported by climate targets and government subsidies. Automotive electrical systems aren't getting simpler, they're becoming more complex every model year. Medical applications aren't shrinking, they're growing as populations age and healthcare technology advances. So if prices today can't meaningfully curb industrial demand, and if mine output can't ramp on any relevant timeline, where does the market actually clear? At what price level does equilibrium finally show up? That's the calculation waiting to be made when liquidity returns in January. And with 145000 futures contracts concentrated in the March 2026 window representing buyers who need metal and speculators positioned for different outcomes, the resolution isn't a mystery. It's an inevitability wrapped in a calendar-driven liquidity crunch, sitting on top of 7 years of structural deficits, magnified by record industrial demand that can't easily be reduced, and triggered by the worst liquidity window of the entire year. Ghost Week isn't creating this crisis. It's simply taking the mask off and revealing how severe the supply-demand imbalance already is. When markets reopen in early January, every industrial buyer who delayed purchases during the holiday blackout faces a binary choice: pay whatever price the market demands, or risk missing physical delivery obligations tied to February and March production schedules. There's no third option. You can't manufacture solar panels without silver, you can't pause automotive electrical system production, and you can't tell customers to wait until prices look better. So let's translate this into practical terms. We start from the current base price. Technical analysts can map out clear resistance zones from chart patterns and historical price behavior. In a normal, liquid market, pushing through those resistance levels might take weeks or months as buyers and sellers work through price discovery across millions of small trades, but these are not normal conditions. The next meaningful resistance shows up at the kind of round number psychology levels that repeatedly matter in commodity markets. From where we're starting, that implies a sizable percentage move. Now let's put that percentage move against the scale of 145000 futures contracts. Each silver futures contract represents 5,000 ounces. So 145000 contracts equals 725 million ounces of notional silver exposure. At current prices, that's tens of billions of dollars in notional value. A strong move higher increases that notional value by billions more. And here's the crucial point most people miss. That multi-billion-dollar swing doesn't just sit on an accounting statement as an unrealized gain or loss. In futures markets, daily price changes trigger margin calls, real cash that has to be posted with brokers by the close of the next trading day. So if silver gaps higher in a matter of hours or a few days, every short position holder, every commercial hedger caught on the wrong side, and every speculator betting on mean reversion can face immediate margin requirements that add up to billions of dollars. And what happens if those margin calls land in the first week of January, right as liquidity begins to return but is still thin? You get forced liquidation. Traders who can't meet margin calls are required to close positions at market prices, no matter how bad those prices are. In a thin market, that forced buying can create a self-reinforcing loop. Buying pushes prices higher, higher prices trigger more margin calls force more buying, and prices surge again. That's the squeeze mechanism in its purest form. It's not manipulation, and it's not a conspiracy. It's math colliding with market structure under extreme liquidity stress. And positioning data from the CFTC's Commitments of Traders reports adds another layer. Managed money, the category that includes hedge funds and large speculators, holds substantial long exposure in silver futures. Meanwhile, the commercial category, which includes mining firms, industrial users, and banks offering hedging services, shows significant short exposure. Those commercial shorts were completely logical when they were established. If a mining company expects to produce 1 million ounces over the next 6 months, it naturally hedges by selling futures contracts to lock in prices. An industrial buyer that already holds physical silver inventory may hedge by shorting futures to protect against price declines. A bank providing hedging services may take the opposite side of client trades. In normal markets, all of that is rational, standard hedging behavior. But when the market slips into a liquidity blackout at elevated price levels, while open interest is sitting at record highs, those safe hedges can turn into potential liabilities worth billions. Now look at the timeline we're dealing with. On December 26th, liquidity effectively disappears. December 27th through 29th is the weekend, with virtually no meaningful trading. December 30th and 31st bring skeleton staffing, year-end book squaring, and minimal volume. January 1st is a global holiday and markets are closed again. On January 2nd, markets technically reopen, but with plenty of traders still away, real liquidity likely won't come back until January 5th, or even January 6th, when everyone is back at their desks. That's 10 full days where the price discovery engine is basically frozen. But industrial demand doesn't freeze. Solar panel factories in China, India, and the United States keep operating through the holidays. Automotive production lines keep moving. Electronics manufacturing doesn't stop for Christmas. And manufacturing industry data suggests many facilities actually speed up production in late December and early January to hit quarterly targets and work through order backlogs before fiscal year-end reporting. These companies need physical silver delivered to their facilities on schedules that don't care about market holidays. So when industrial buyers return to the futures market on January 2nd or 3rd to execute purchases they postponed during the liquidity drought, what price will they meet? whatever price the market requires because there isn't an alternative source of immediate supply. Physical silver doesn't appear out of nowhere. It has to be mined, refined, transported, and delivered processes measured in weeks or months, not days. The March 2026 futures contract became the front-month trading vehicle on November 22nd, 2025. That means every new position, every roll from December contracts, and every industrial hedging transaction has been funneling into March 2026. And March delivery is only about 2 months away once markets reopen in January. 2 months sounds like plenty of time until you think about the real-world logistics of physical delivery. If you're a futures holder who intends to take delivery, you need to give notice, arrange vault storage or transportation, coordinate with refiners and logistics providers, and execute payment transfers. Those steps require planning in weeks, not days. CME Group delivery procedures require participants to provide notice of intent to deliver or take delivery well before contract expiration. As March 2026 approaches, the window for orderly delivery arrangements keeps shrinking. Industrial buyers who genuinely need metal can't wait until the last minute they have to secure positions in January to ensure February and March delivery. This creates a binary forcing mechanism. Either industrial buyers pay whatever price is required to lock in March contracts in early January, or they risk being short metal for spring production schedules. There isn't a middle path. You can't build solar panels on promises of future deliveries. You need physical silver on real production lines, on real timelines. Now let's address the catalyst that shifts silver from just another commodity into something treated as a strategic national priority. In 2025, silver was designated a United States critical mineral. This isn't a symbolic label. It's a formal acknowledgement that silver is essential to economic and national security, and that its supply chain is vulnerable to disruption. According to the U.S. Geological Survey, critical mineral designation activates multiple policy levers: preferential permitting for domestic mining projects, inclusion in strategic stockpiling considerations, trade policy protections, and stronger monitoring of supply security. We don't have public numbers for strategic silver stockpiles, but the simple fact that government procurement could step in as an additional demand source adds another layer of pressure to an already tight supply-demand setup. Think about what critical mineral status means in practical terms. The U.S. government is explicitly saying silver supply matters to national interests. Solar panels for the renewable energy transition need silver. Defense electronics and military hardware need silver. Medical devices and hospital equipment need silver. 5G telecommunications infrastructure needs silver. And when a commodity becomes strategically essential, price becomes secondary to security of supply. If a government agency decides stockpiles must rise for national security reasons, it buys at market prices regardless of where silver is trading. The strategic calculation overrides the financial calculation. That introduces another potentially inelastic demand bucket on top of the industrial demand we've already discussed. And remember, global silver mining produces only 813 million ounces annually, a figure that hasn't meaningfully increased since 2016, despite dramatic price appreciation over the past year. Here's the supply-side reality nobody can engineer around. You can't ramp silver mine production quickly. Even if silver prices surge and mining becomes extremely profitable, developing a new mine from discovery to production typically takes 5 to 7 years. You need geological surveys, environmental permits, infrastructure build-out, equipment procurement, hiring and training, and construction of processing facilities. According to S&P Global Market Intelligence data on mining project timelines, the average greenfield mining project takes about 6.5 years, from final investment decision to first production. And that assumes you already have a discovered deposit, completed feasibility work, and secured permits, each of which can add years before that clock even starts. So if silver prices spike in January 2026, when does new supply show up to rebalance the market? Not in 2027 and not in 2028. If we're starting new projects from scratch today, it may not be until 2031 or 2032, assuming prices stay high long enough to justify billions in capital investment for new mines. And assuming those projects don't run into regulatory delays, environmental hurdles, or local community opposition, that's why this supply-demand gap can't be closed by ramping production on any meaningful timeline. So the market is forced to clear through the only mechanism available: price rising until demand is destroyed or substitution takes place. But as we've already established, industrial silver demand is unusually difficult to break through price increases alone. Solar manufacturers are locked into technology roadmaps set years ago, with billions already invested into TOPCon production capacity. They can't simply shift to silver-free panels. The technology isn't available at commercial scale, so they either pay the higher silver price or they shut down production lines. And shutting down means defaulting on customer contracts worth far more than the extra cost of silver. Automotive companies face a similar reality. Modern vehicles depend on sophisticated electrical architectures that rely on silver's unique conductivity. Redesigning those systems to remove silver would take years of engineering work and billions in retooling costs. In most cases, it's cheaper to pay elevated silver prices than to re-engineer entire vehicle platforms. That's what creates the math-driven certainty behind a squeeze scenario. When supply is constrained, demand is inelastic, and inventory buffers have been drained by 7 consecutive years of deficits, the only variable left is price. And in a market facing a liquidity crunch during the worst trading window of the year, price doesn't adjust gradually. It jumps violently to whatever level is needed to reach a temporary equilibrium. Now let's walk through a plausible chain reaction, one that becomes more likely the deeper you go into the data. Markets reopen on January 2nd after the 10-day liquidity blackout. Industrial buyers who postponed purchases during the holiday stretch immediately step in to secure March 2026 contracts for spring delivery. Hedge funds and managed money players riding momentum see confirmation and add to long positions. Meanwhile, commercial shorts comfortable with their hedges at lower price levels suddenly face margin calls as prices push into technical resistance. Some can meet the calls, but others, especially smaller players or heavily leveraged participants, are forced to buy back shorts and close positions. That buying pressure pushes prices through the first resistance levels. Once resistance breaks, chart-focused technical traders read it as a breakout. Algorithmic systems designed to follow momentum trigger additional buy orders. Prices begin climbing fast. Commercial shorts still holding on face larger margin calls, forcing more buying. The squeeze tightens. More liquidation follows, and then major psychological price levels start to break. At this point, prices have already moved a long way from the Christmas Day close, but here's the uncomfortable question. Why would it stop there? If the underlying supply-demand imbalance hasn't been fixed, if industrial buyers still need metal, if inventories are still depleted, and if mine production hasn't magically increased, what exactly prevents price from pushing even higher? In a short squeeze, price doesn't stop politely at reasonable resistance levels. It stops when shorts are fully flushed out, or when meaningful new supply shows up, whichever happens first. And we already know new mine supply isn't arriving for years. So the market runs until shorts capitulate completely, or until industrial buyers start canceling orders because silver has become outright unaffordable. At what price does a solar company walk away from billion-dollar panel contracts? At what price does an automaker postpone a major vehicle launch? Those are the real resistance levels, the pain points where demand finally breaks. Nobody knows precisely where those thresholds sit, because we haven't tested them under fundamentals like these. Earlier silver spikes happened under different conditions. Past rallies were largely investment-driven and speculative in nature. This time, it's industrial demand colliding with structural supply deficits during a liquidity crisis. The dynamics are not the same, and history shows what can happen when industrial commodities hit this kind of setup. Palladium surged from roughly $500 to $3,000 an ounce between 2016 and 2020 as automotive catalytic converter demand outpaced mine supply. Lithium carbonate jumped from about $6,000 to $80,000 per ton in 2022 as battery demand overwhelmed production capacity. In both cases, prices didn't climb in a slow, orderly way. They exploded higher in month-long runs that caught most participants completely off guard. Silver is setting up for a similar type of move, except with much less warning because the liquidity crisis compresses the timeline. Instead of a rally that unfolds over quarters or years, we could see major price action compressed into days or weeks. Before we wrap up, if this analysis has been useful, make sure you're subscribed and have notifications turned on. Here's what individuals watching this need to understand. The liquidity blackout begins December 26th tomorrow. By the time you're seeing this, the trap may already have snapped shut. The market has entered, or is about to enter, Ghost Week. The 145000 contracts, representing 725 million ounces and tens of billions in notional value, are effectively frozen in place. And when markets reopen on January 2nd or 3rd, the price you see at the opening bell could be dramatically different from the Christmas Day close. Futures markets are allowed to gap. There's no requirement for continuous price discovery. If enough buy orders stack up during the closure period, the market can simply reopen far higher with no trades in between. For those holding long exposure to silver, whether through futures, mining equities, or physical metal, this is the kind of scenario many have been waiting for. The mathematical setup is about as clear as it gets. Structurally tight fundamentals colliding with a predictable liquidity crunch at elevated price levels, with open interest sitting at unprecedented highs. For those who are short, or for anyone operating without proper hedges, the next 2 weeks carry existential risk. You can't adjust positions during Ghost Week. You can't manage risk in real time if your broker calls for margin. And you can't exit losing trades in an orderly way. You're locked in until liquidity returns, and when it does, you face whatever price the market is willing to print. For industrial users who need physical silver to keep production running, this is the moment to review your supply chain and hedging strategy with total honesty. If you're relying on spot purchases in January or February to cover spring production requirements, you're effectively betting this entire analysis is wrong. You're betting the supply-demand imbalance somehow resolves itself. You're betting liquidity comes back smoothly. You're betting prices stay stable despite the weight of evidence pointing the other way. That isn't hedging, that's hoping. And hope is not a strategy when the math is this unforgiving. The potential squeeze isn't a prediction that depends on everything lining up perfectly. It's an observation of what typically happens when you combine 7 years of structural deficits, record industrial demand that can't easily be reduced, 1-4-5-0-0-0 futures contracts concentrated in a tight delivery window, critical mineral status adding strategic demand, and the worst liquidity conditions on the entire calendar. The math is simple. The setup is obvious. The catalyst is guaranteed by the calendar. And when billions of dollars of forced buying hits thin liquidity against a tight supply backdrop, there's only one direction the market can resolve. Ghost Week begins tomorrow. The squeeze mechanism is already locked in. And when markets reopen in January and people ask how silver moved so dramatically, so fast, the answer will be obvious to anyone who followed the mathematics. Because when liquidity disappears but obligations remain, price doesn't negotiate. It simply jumps to whatever level is needed to clear the imbalance. And with 1-4-5-0-0-0 contracts, a 148.9 million ounce annual deficit, and 10 days of frozen price discovery, that clearing level is mathematically likely to be very different from where we closed on Christmas Day. The only question left is whether you're positioned for what's mathematically probable or whether you're betting the math is somehow wrong. By January 2nd, we'll all have the answer. The data will speak for itself. Until then, stay informed, stay critical, and remember, understanding market mechanics is always more valuable than hoping for the best. This has been an educational look at silver market structure during a unique liquidity event. Thanks for watching, and I'll see you in the next one.